Okay, let's get started. This is Patrick Zielbauer from Infinity Futures in Chicago. Welcome. Thanks everybody for coming. It is 3:30 on Thursday, March 9th, and we're here with Martin from Hit the Mark Trading to do a webinar for everybody here called Just Day Trade. We appreciate everybody coming. We're going to read through some risk stuff real quick. If you have any questions about anything here, please ask, and we'll make sure to get it addressed for you, okay? Trading futures, options on futures, and retail off-exchange foreign currency transactions involve substantial risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not indicative of future results. So, folks, futures this is a risky game. We all know it. Only deposit risk capital into your trading account. That means money you can afford to lose without lengthening your retirement horizon or affecting your lifestyle, okay? Day trade margin, be very careful with the use of day trade margin. As you may know already, even if you use full margin per contract, you're still using a lot of leverage. So that's really something to be conscious of. Again, only fund your futures account with risk capital. And if you ever want to discuss with somebody objectively whether or not this type of trading is for you, please feel free to reach out to us. Everybody here, whether you're a customer or not, has a rep in our office. You can find out who it is by just replying to any of the email you get from Infinity, or send an email to trade@infinityfutures.com, which will go right to our management, and they can figure out who you're working with here. All right, so we do discuss risk very objectively, and we're happy to have that discussion with you. Let me flip this over to the webinar page that we've got here today. Today we're going to be working with Martin from Hit the Mark Trading. So how did this come together? You know, as many of you know, Infinity is a lot more selective than a lot of our competitors about who we work with, who we associate with. We are a brokerage firm, so we're highly regulated. We do a lot of vetting. We make sure our partner's promotional material is proper, make sure that the website is clean and so forth. That really means a lot to us. And not everybody that wants to work with us wants to make such changes to their site, or they want to be able to keep the picture of their private jet on their homepage. That's nonsense. We don't deal with that. So Martin and I came together a while back. We sought him out and we made contact through the website, and he became a customer. And Martin's been a client of ours for a long time now. He's very well versed using Infinity AT, and even though he came from a couple different charting backgrounds, he actually became really proficient in Sierra, which we really appreciated. But Martin is an excellent partner of Infinity. I want to touch on a couple things before we turn it over to him. Number one, he's probably going to talk a little bit about the Rooster Call, which is his newsletter that goes out every morning. You guys probably get a lot of videos and emails, and every morning you get tons of videos and so on. Definitely get a trial of the Rooster Call that he sends out every morning. It's one of the few things that I try to read every day. I get tons of email, probably more than you guys do, related to trading and videos and so on. The Rooster Call is concise. It's clearly written. I think it takes him a long time to write it. It doesn't take a long time to read, but I know it takes a long time for him to write it. Basically what he's doing is he's giving us a picture of what happened overnight, quick summary, things he's looking for. There's a political section, not necessarily opinions, but talking about what's going on and what's affecting the market, maybe a discussion about interest rates, different commodities. It is a really nice way to just kind of sit down in the morning and read through something that's very well written and clear, and then you kind of have a picture of what to expect. So if that's something that you are interested in, I highly recommend you sign up for a trial of that. I'm going to put a link to it in the text box here in a little bit as soon as I stop talking. So if you want to try that out, that's one thing I really do recommend you take a look at. As far as what Martin does with his educational courses and so on, I have a couple of clients who have, quote unquote, been through the ringer, with the educational environment over many, many years. And a couple of these guys act as kind of a litmus test for me of whether or not a third party that we work with is offering a good product, and their level of satisfaction means a lot to me because they're my customer, and oftentimes they find these partners through me. So there's a couple of people who've been through Martin's class who had been through everything, and they gave me really, really good feedback as to their experience with Martin's boot camp classes, and that means a lot to me because these guys have, again, been through the ringer, bought every indicator, and so on. A lot of times the people that we send over to Martin are people who have already purchased tons and tons of indicators. Maybe they've gotten so granular and detailed into their analysis where they can't even think about it anymore. If you want to kind of wipe the slate clean and just start fresh, and try to look at something that's very simple that you can start using the next day, this is a webinar that I think will be useful to you. One of Martin's claims is that he can give you something actionable, meaning you don't have to go watch like 40 YouTube videos tonight to be able to do this tomorrow. That's one of the things, that's one of the reasons why we like doing these events with Martin, is because he's going to show some things here that you can go on your charts tonight. Even if you're not a customer of ours, we hope you will be one, but even if you're not, you can go on this, on your charts tonight and see the sorts of things he's talking about, and then use them tomorrow. So that's something we appreciate. Something actionable, that means a lot. It's not just a sales pitch. This is something anybody can use. So we appreciate that. So with that being said, I'm going to flip it over to Martin. Thanks everybody for coming. My name is Patrick Zielbauer. Please feel free to type in questions. I'll be sort of watching in the background and listening. If anybody needs anything, feel free to ask. All right, so Martin, I'm going to make you the presenter. I'm going to turn my mic off and my camera, and the floor is yours. Okay, thanks everybody for coming. Much appreciated.
Okay, Patrick, I really appreciate it. Thank you very much for that very nice introduction. I certainly appreciate it. Let me see if I can get my screen up. All right. You should be able to see my screen now.
Yep, looks good. Yep, you're good to go. You're good to go.
Thank you. Appreciate that. Okay. All right. As Patrick said, yes, I'm a client of his, and I tell you, I have been through where a broker folded, took a lot of trading capital away, and you can't do anything about it. So when I was looking around, it took me a lot before I decided to really settle down and work with Infinity, and Patrick was the deciding factor. And what I mean by that is just someone so concerned, and any question, he's just right on the spot with an answer. I really appreciate that. I value it highly. And so it just morphed into a situation where now I'm helping with education, and their commitment to education is really admirable. So thank you all for being here today. A little bit about me. First off, we're all adults. Trading financial instruments using contract stocks or options is extremely risky. Only trade with money that you can afford to place at risk. Past results do not guarantee future results. Please consult a licensed professional prior to trading using real money. And paper trade to learn any new concepts. Paper trade regardless of your level of expertise. Briefly, I've been doing trading for 25 years, 10 years plus full-time. I launched a teaching newsletter in 2008. I've moved this to video format because clients wanted something they can just quickly look on their phone and listen to while they drive to work. I publish a video Monday through Thursday and then a big one on the weekend. I have these intensive boot camps about 4, maybe 5 times a year. Maybe 2 years ago I created the Just Day Trade, and what we're talking about today will come directly from my Just Day Trade course. This is me in sunny Southwest Florida. That's my office, the house. What I like to do is provide market perspective, calling trades, educational trades in advance so that people can see the concepts that I teach actually work. That's the deal. And I really want everyone to trade on paper because you only learn when you actually initiate the trades yourself. What the newsletter does is reinforce your training. Everything we do, we have an all-encompassing view, price action, price oscillator, and I do like to look at linkage between markets. Patrick mentioned the rooster call. You can go to the website, hit themarktrading.com, go to the contacts page, and I'll send this to you for about 30 days, sometimes more. It's whenever I get around to updating that list. But it is a morning brief for what I feel is a day trader perspective. You can find more about just day trade. If what I mentioned to you today speaks to you, then, trust me, this is over the 6 hours. Plus it's a month of a live real-time room, but I limit that only to people who have taken the course, because I really want people to learn this stuff, not new people coming in constantly asking questions. Why is your indicator this color and stuff like that? The boot camp is for position traders, and I just am in a pre-launch now on seasonal forecasting. This is a very brand new. I don't think I've talked to Patrick about this at all, but it's brand new. And for example, here's a yen seasonal, and every single time in the fall the yen goes down. And so one of the educational trades was worth $11,000. It's amazing, isn't it? I thought I had one for gold. I was going to show you gold. We got into the gold, or we were watching the gold seasonal, and my gosh, it was exact. The gold went up exactly when the seasonal said it would, and then the gold said it would fall after February 24th, and you see what gold's done. So it's really interesting. All right, that's it for my commercial. Let's talk about what is momentum trading. Momentum trading is the art of spotting a market ready to move, selecting a trade, entering the trade with confidence, and using predetermined exit points. And the more mechanical you make this, the better. Momentum trading builds off a firm understanding of support and resistance, along with known areas price is attracted toward moving. So we are trading directionally, up or down. We are riding the price wave rather than reacting to what might happen. And this is usually accompanied by a price oscillator. In my day trading course, the first hour, I don't even use any kind of an indicator whatsoever, just to show people that the indicator merely confirms what you already see happening on the chart. Momentum trading can be used for intraday or short term, whether you're holding a few days or weeks. Today we're talking about day trading. And by the way, if you have any questions, please hold it to the end. I'll answer every question, but I get so involved in my conversation with you in explaining this, I get lost and I don't look at the questions. So the first thing you're going to do in the morning, you want to determine the trend. So the intraday trading uses a daily chart for the big picture, okay? And then for tactical entries, you are using a short-term chart. As a general rule, the more volatile the market, the smaller the time frame. What does that mean? If you've got an active market, you can go down in size of how you're measuring the market. I will look at like a 15-minute chart just to, okay, what's the big picture? But beyond that, I really prefer an activity-based. Now, we know that markets move in 3 directions, up, down, and sideways. If the market is sideways, we are greatly challenged unless the range is large. So as a day trader, it is absolutely imperative to find moving markets. And this means, for example, ES futures traders, and I know there's a lot of people that's all they want to trade, but they must expand their horizon at time to other futures which are showing movement. Okay? To identify trend, and I'll show you some charts, we're going to bracket price with trend lines. Daily chart and intraday chart. And we have this very complex, highly technical idea that price is simply going to bang back and forth the price trend lines. All right, now what this chart shows you, if you'll focus on it just for a moment, let me see if I can find my drawing tools here. Okay, good. I want to point out this. This is August. Now, if you're wondering when are you going to take your vacation, you're going to say, as a trader, I want to take my vacation when the rest of the trading world takes the vacation, because this is August. And it is absolutely horrible. So last August, no index trading, gold and crude. Index futures, they were just like this. It was extremely difficult. But look what happened after the election, all right? The election sent things up, pull back, and then shoot up. And then in December, we went absolutely sideways. And it looked to me just exactly like August, just horrible. Maybe there was a day or two showed some better range, but beyond that, it was horrible. Absolutely, for the day trader, horrible. Okay? And what that means is very slow. A move would actually take a very long time to occur. So, you know, you see this and you say, why am I putting myself through this? When you look at crude, or you're looking at gold, or you're looking at something else that is moving, okay? A lot of people, a lot of new people to trading, and it happens to me. If I'm testing a new system, let's say, and we've just been in some really good markets, and gosh, everything looks wonderful, and you say, okay, well then I'm ready to put some money on this thing. And then the market just decides, as soon as you enter, that it's going to embark on 3 weeks of this kind of action. All right? Now, I'm telling you, this is so common. It's Murphy's Law, right? So just understand that all of the good paper trading you were doing, it's really nice if you can go back to times when the market is sideways. I mean, I'm telling you, if you get a strategy that is working super in August, you probably have a really golden ticket. Just a thought. I just want, because I know a lot of people will be trying new systems, or you're new to trading and you're about ready to use real money, and you know, you're just going to get so discouraged when you see the market just stop moving. All right? All right. So in the morning, you know, you're looking at the daily chart. Of course, you got this already line drawn. And this is an art, not a science. So, you know, you'd probably have a line drawn like that first. Okay? And all you're doing is you're saying, well, if I do fall back, I'm probably going to land around here, and then that'll be probably a great time to go long, okay? And a lot of times on the day trading chart, I'm sorry, on the daily chart, a lot of times when you do hit one of these lines, it's a good little forecast for you that the next day is going to be good in the day trading. Might have some range, okay? Just something to look at. All right, let's take a look at the crude market. Here's daily crude. Now, notice the difference in these charts. I mean, this chart really shows, this is a daily chart, this is a daily chart, okay? All quiet on the Western Front in the ES, and the crude is just all over the place, okay? Now, the daily chart here immediately shows that it was not very good for position trading whatsoever until this week, but nothing at all for position traders, because as soon as we hit the bottom of the box, we go to the top of the box, okay? But for the day trader, this was absolutely wonderful because of the range, okay? Now, I believe that drawing trend lines is going to help your brain to frame the price action. And that's all we're doing. Simple concept. So in the morning, before you even start trading, you just draw the box up the action. Because when you eventually see a breakout, it can be a big deal. A big deal, okay? Come on, Rhymes. So here we are now showing more of the day. And was it a big deal when we broke this? Yeah. So I mean, granted, it happened at 5 o'clock in the morning. I'm not saying anybody caught that trade. The Europeans, I think, are at a really nice advantage because a lot of moves are happening in the 3, 4 o'clock hour, big time. If you are an early riser, this is what you do. Okay. So meanwhile, this has occurred, and now you're saying, all right, well, now I can do a line here, right? And you don't know where it's going to go. You just draw the line, right? And then it hit the extend button. Well, gosh, look what happened today. When you broke that, we went down, okay? So unbelievably simple. Nobody does it. Simple. And we're not even talking about an indicator yet, okay? All right. Now, drawing trend lines is an art, not a science. Don't obsess over it. Just practice. Support and resistance, the reason I'm talking about trend lines, support and resistance is huge in momentum trading. And you want to learn how can you identify probable areas price wants to touch over and over again. Now let's go into the talk about oscillators. Understand that oscillators derive their power from price movement. This is why I'm really big on understanding how to read price action at support and resistance levels. The oscillator then provides a trigger point for entry. Now here's what most traders look like when they're trying to figure out which oscillator to use, okay? Do you remember the story about the 6 blind men? And they all come and feel a different part of the elephant, right? And they're trying to identify what it is by the different things they're touching. Well, a lot of times traders get locked in, and you get somebody and they say, oh my gosh, MACD, oh, MACD is just the best. I couldn't live without it. And then somebody else says, no, this is our RSI is the best, RSI. Someone else says, no, percent R. Bollinger Bands, oh, my Bollinger Bands, couldn't live without them. Somebody else says, well, you know what, mine's the best, it's expensive, it's proprietary, it's got to be the best considering what I've paid for it, right? And then somebody else says, well, nothing wrong with slow stochastics, that's what it feels like to me is the best, okay? Now tons of oscillators exist out there because it's a big business, and everyone has their personal favorite. Now, if you are sitting at your house or your office after market hours and you're looking at daily charts and weekly charts, I don't care what you put on your chart, you can use everything. I did. I used on the daily charts slow stochastics, MACD, wins percent R, and RSI, and I had the Bollinger Bands on there, I'm sure. And you know what? When you have the luxury of time and you're just kicking back, you can do all kind of analysis and really convince yourself this thing's going to go. But at present, I just use one indicator after years of trading and my desire to simplify. So I use the Commodity Channel Index. It's also called the CCI. Now, one of the most important things you'll learn today, no one talks about, in a strong momentum market, all price oscillators work, and I mean everything. So whether it's a free oscillator, whether it's a one time I made up a moving average cross about 3 hours before a presentation. I never tested it, but I put the 7 and the 21 on the chart. Simple moving average. Guess what? In a moving market, it works. Everything works. In a tight range market, all price oscillators lose their predictive value. All of them. Okay? That is the biggest secret. In a tight range market, all price oscillators lose their predictive value. So this is just one more reason that you should monitor several markets looking for momentum. Now, Commodity Channel Index, it's an oscillator created by Donald Lambert. I met Mr. Lambert. In a moving market, the CCI is shown to lead price. Now, don't take my word for it. Check out John Murphy's book. He has a book called Technical Analysis of the Financial Markets. If you wish to become a chartered market technician, this is required reading. And he spends maybe half a page talking about CCI, no big deal, because he's covering a lot of different indicators. But here's what I want you to see. Notice that the CCI turns before prices at each top and bottom. And that's huge. Seeing is believing. Put it in print and it's proof. So what's he saying? Okay, look at the CCI going down and then the price finally goes down. Here's the CCI going up, and guess what? Price goes up. All right? Simple. Now, obviously, the more I got into this and dug into this, the deeper we put filters and nuances and different things like that to help us out. You're going to learn that today. As far as the CCI, all you need to know is that we're comparing price with a simple moving average over a selected time span. Mr. Lambert suggested a 20-day period. That comes default on the Sierra package or any of the charting packages. It's the default. Other people will modify Lambert's suggestion for intraday use, including using a 14, a 6, and a 5 period. I mean, I've seen all kind of numbers out there. All of this stuff is already calculated for you with the software platform. All you do is define the period. I will show you the calculation, but I'm a very, very visual trader, and I'm not going to have to prove anything like this to myself. But if you want to memorize this, simply pause the recording that Patrick gives you and have at it. Again, I think I'm a visual trader. Most day traders are. Just know that the CCI is plotted on a histogram. I'll show you the chart. The 0 line represents major support and resistance. The 100 and 150 line represents minor support and resistance. So let's really jump into this. So here we are, the histogram, and again, I really appreciate Patrick coded all this. So here's the 0 line, okay? Right here. This line right here. This is the histogram. So this is the 0 line. So what this is basically telling us is major support and resistance. If we're up above the 0 line, say by 5 to 6 bars, then we say, okay, we have an upward bias now. If we're down 5 to 6 bars, we say, okay, we have a downward bias. Here's the 100 line, minor support and resistance. Here's the 150, minor support and resistance, and the 200 is just called extremes. Rarely are we going to get up there. Here's the, or I should say rarely will we stay up there. Here's the minus 100, down here's the minus 150, and here's the minus 200. Okay? Color coding really helps, doesn't it? All right, let me go to another chart. Now we're going to talk today about the diagonal trendline break. This is very powerful, very auspicious. And what I'd like you to do when you start practicing this is to draw it from the plus or minus 150 line. It's a very, very simple concept, the diagonal trendline break, and it's just a wonderful tool. So let's just take a look here, and you can see I've got a diagonal trend line right here, okay? I'm calling this a trend trade because a CCI trend trade now, CCI trend trade, because the CCI is over the 0 line by at least 5 bars. So we get the diagonal trend line break, and he says, okay, price is going to go up. Now, we're drawing it from plus 150 or higher, check. Come on down. We just kind of write it right down there. and we broke it. It says we're going to go up, price went up. Here's another one. We start it from above, 150 or above. We touch it here. If we can have a touch, that's even better, because it represents CCI tried to go up like a battering ram, couldn't do it and fell back. So you get 1, 2, draw that line, and then just draw it out, extend it out. Now because the CCI bias is red, then we say this is a counter trend trade, right? Because the CCI is saying, hey, we're down. Prices, we have a downward bias. So if you get this diagonal trend line break, understand it's a counter trend trade. Well, what happened? Price went up. This is today's crude, by the way. Here we go again. By the way, this is early morning stuff. Crude traders know, or should know, we always expect to move at the 7 o'clock hour, the 9 o'clock hour, and the 2 p.m. hour, just for your information. Okay, so here we go. Diagonal trend line break, up. Diagonal trend line break, up. Okay, and on it goes. I'll show you another chart. So, wow, I really blew this one up. What I'm showing here is diagonal trend line break. Here's where it occurred. The green vertical line. And here's another one, the green vertical line. What happened to price? Hello. Up. What happened to price? Hello. Up. Isn't that something? It gets better. Come on, where'd my deal go? Okay. For intraday use, what I want you to do is change that default setting from 20 to 14. Adjust to 14 from the default 20. Now this is for day trading. If you're going to be trading on a chart over 60 minutes, 20 is fine. Daily chart, 20. Weekly chart, 20. It's fine, no problem. But intraday, everything is fast, okay? Everything moves a lot faster, so 14. Smaller time frames in moving markets with good range. Now, trade in the rush hour instead of all day. This has worked for years, me saying this, okay? Trade during the rush hour instead of all day. But if you've been day trading lately, you know how absolutely painfully slow the mornings are. And I haven't seen anything like it in a very, very long time. I mean painfully slow. Now, this is a great pattern for trading. I'm going to show you protective stop. I'm going to show you, we'll talk about taking profit. This is something you can immediately test. Yes, there are 4 other CCI patterns that I use and teach, along with other robust setups, filters, and nuances, right? Because what's the objective is finding the higher probability trade. But I'd probably say 50% of the trades are accomplished with what I'm showing you right now. So it allows for immediate testing. The key point I'd like you to remember is draw the trend line starting at plus or minus 150. Better trades in markets showing momentum. If the markets are absolutely sluggish and very tight range, it is going to be difficult, very difficult. We have something we do for that. You just box up that difficult, slow, tight range, and you just wait for price to make a move, because otherwise you are going to be absolutely pulling your hair out. At least I tend to. It's like, you know, this is not the market I'm used to. If I can't draw a trend line, do I want to take the trade? Let's talk about it. Diagonal trend line break with trend, plus or minus 50 line. Draw it from the plus or minus 150 line. use a confirmation price bar close unless the trend is super strong. Now, I would only suggest counter trends after you've mastered trend trading. Don't try to just accomplish everything in one day, right? Slowly take one part of the concept, apply it, build on that. Now, the protective stop rules are very important, and this is a mechanical strategy. If you're going to go long, you place your protective stop below either the trigger price bar or the price bar prior to the trigger. Whoever is lower, then you go long, okay? You can always move it later, but that's where it should be initially. If you're short, place your stop above the trigger price bar or the prior price bar to the trigger bar, whoever's higher. Now, a lot of information here. Let's just go through this real slow. Here we go. Diagonal trend line break. There's the vertical line. The protective stop goes, who's lower, the green bar or the red bar? The trigger bar is lower, so that's where your protective stop goes. Good. Diagonal trend line break, vertical line, who's lower, the trigger bar or the bar prior? It looks like the trigger bar is lower. Great. And up we go. Diagonal trend line break, who's lower? It seems like the previous bar is lower, so that's where your protective stop is. Great. Diagonal trend line break. These are all multiple entries. I mean, I'm not saying that a person couldn't enter and just run it with a trailing stop, okay? To each his own. I just want to show you the number of entries in today's crude. So here we go. Right here where I've got this bouncing red ball, the bar prior to the trigger was lower. So you're going long, you put your stop just below that bar. And by the way, I'm using a 10 range bar chart. That means every single price bar has traveled a range of 10 ticks before it prints. Since this is a mechanical strategy, always using the same placement of the price bar, I already know that I'm always risking on a trade at least two of these guys, about two of them. So let's say the 220 bucks is what I'm risking, okay? Which on crude, that's what, 20 ticks, okay? Now you can modify this how you want to. Here we go, diagonal trend line break. Here is the vertical bar. Looks like the previous bar was higher, so that's where protective stop goes. Now, look at this thing, would you? Look at this mess. Unbelievable, right? So this is the kind of stuff that drives me up a wall, because I remember the good old days. No, it just really, you know, it's like, come on, really? But notice that in this trade, even though we got into this, you were never stopped out. If you're comfortable with the protective stop, I'll never forget the guy who helped me, a guy who had been trading for 50 years and managed money, futures. He said, look, put the trade on and walk out of the room. Don't look at it. Okay, diagonal trend line break. Stop goes just, looks like it was the trigger bar where the entry should, or the protective stop should be. Okay, great. Another one, because you're bouncing around chopping up here. The stop is just above the bar previous to the trigger. Here's another entry. The bar is just above the previous bar to the trigger, right here. Okay. So my point is every single trade worked. Every single protective stop worked except for one. Got it? How much is that worth? Is that worth your 1 hour of coming to this class today? All right? I told you you'd get something actionable you can work with. This is the best stop method I have found. For me, I mean, it speaks to me. If you think you're going to trade crude and you're going to risk 6 ticks, I'm sorry. This animal will turn around and bite your hand before you know what has happened. You're holding your head in your hand and say, oh, gosh, they cut my head off. I mean, you really need to know your instrument. So this is one, it did not work, but just applying the rules. And by the way, with the CCI, you got to wait for bar close, because this CCI is going to be flipping all over the place until that bar finally prints. You wait for the bar close. So in all of these trade examples, one failed. Now, I generally say that it's rare for us to have 2 losing trades in a row, but this is something where you need to prove this to yourself, because no 2 people trade exactly the same. So you need to set out and prove it to yourself. So what does that mean? Well, that means you're going to budget in your trading, you know, the idea, hey, you might get 2 stop outs in a row. Obviously, every day is different. Every instrument's different. But this is how you plan your money. Okay? All right. My gosh, look at this. Hello. Goodness gracious. So the protective stop goes underneath the trigger bar. And, you know, up we go. It's just wonderful when a market moves. This is really challenging. I understand that. I understand that. If you can't take it, then you box it up and you wait and you say, okay, price, you don't know what you're doing. If you don't know, I don't know. So when you make a decision to make a move, that's when I'll join you. And that's what we do. We do that all the time. Okay. We're going pretty good here. Let me get rid of these drawings. Please, where's my erase button? Okay. Now, as far as profit, this is the most difficult part of my teaching, because I don't know, I cannot read people's minds. All right? Everybody would love to make $1,000 on a single trade, right? And you know, they hold, and then the trade goes against them. They think it's going to come back, and then all of a sudden, they're down $1,000, you know, over and over and over. Some people will only I have a friend. This guy manages money. 3-tick Charlie, and he's the happiest trader I know. 3 ticks, I'm out. And he's trading some size. So if I say, hey, did you see that move yesterday? We both kind of laughed, because I know the man took 3 ticks. But he's taking a lot of trades. 3 ticks. All right. If the CCI on profit targets, let me say one more thing. Very personal issue here. All right. Today, in the trade room, we were in crude, and I expanded the profit target. I said, you know, if they ever break out of this box, we're going someplace, okay? So we perfectly measured where it was going to go. And it was such a fast move, it comes right down, top ticks, and pops back up. Yeah, you're going to get that. You just have to laugh and say, okay, welcome to trading. Otherwise, if someone says, I just want to make 5 ticks, who am I? You know, a lot of times I'll go for 8 ticks and 30 ticks on the NQ 15 and 30. Okay, sometimes It's just all in, all out 8 ticks. You know, what's the market giving you? Is it moving? So this is a very, very, very personal issue, profit taking. It's your relationship with money, your relationship with fear, it's the relationship with your ego, and it also has a lot to do with your account size. Okay, if you're going to use CCI, you know that the 150 or minus 150 is minor support and resistance. Therefore, if it has been over that line and it starts coming back, that's your first warning. The first flag, hey, look at me. I might be losing momentum here. If you cross the 100 line, that's it. Time to get out. You've now broken through 2 forms of resistance, okay, minor resistance. Or if you've been drawing a channel line, if that helps you, our saying is the channel line holds until it doesn't. All right, let me check my time here. Goodness. So on here, just going to be real brief here. Here is, for example, right here. I couldn't make it to the 150 line. Okay, that's a little bit of a warning there. And here is, I've crossed the 100 line. Well, look at what the price has done, okay? It's come down. Here we're saying, if anyone had been short for any reason whatsoever, here we're saying, in fact, here's your short signal. Draw it. Diagonal trend line break. Here is a cross of the 100. Here is, if you held for any reason, here's cross back through the 150, and here's through the 100, and look at the price action. So that's what I mean by using the CCI, okay? And obviously, if you were using trend lines, say you had a trend line or something, okay? Let's say something like this. Whoops. I mean, if you see the channel, you might just say, okay, well, I'm just going to take a profit if it hits near the top of that. And you just, you know, you're always extending that out. So, again, I can teach the setups and all of that good stuff, but I cannot read people's minds on what the most appropriate profit-taking consideration should be for their particular purpose or their mind. Everything I've shown you is robust across any instrument, across any chart time frame. It's good on Forex, it's good on stocks, it's good on anything. If an action repeats, we can trade it. Now you're going to be using, I prefer in day trading to use activity-based rather than time-based charts. And what I mean by that is I'm not going to just arbitrarily look at the watch and say 5 minutes went by, let's print the bar. You know, what do I see? No. If it's an active market, I want an activity-based chart. So I've used the 5-10 chart, 5-10 tick chart for years on Euro and crude in the Russell 2000. Now I just use the 10 range bar. On the NQ, I use the 20 range bar or 25, either one will work. The YM, a 15 range bar. Okay. And if it's super slow, I'll pull up a 5-minute chart and I'll say, you know, is anything going on? And I'll look at a 15 every once in a while. If we're just sideways trading $200 range on a day trading instrument, I'm not interested. Bonds, by the way, 5 range bar. I let price resolve the issue because otherwise your oscillator is going to get all these false signals in a tight sideways range and you're going to get chopped up and you're going to say, my oscillator failed me. No, you failed because you didn't recognize what the price was doing. Got that? All right. Let the price resolve the chop. Momentum traders believe they're in for the long haul, taking a series of trades, converting to cash quickly. Runners are for longer term moves. You can consider trading multiple contracts rather than pin your hopes on a single contract. Paper trade prior to using any real money. I cannot stress that enough. Understand your ego and your mind and trade with this as a weakness, okay? You got to understand that. The day trading, fast action, fast profits, or fast losses. You must react. Therefore, you can't wait around for 5 indicators to confirm. And you need to trade with clear charts. If you linger, you're going to miss the trade. Day trading is not position trading. The focus on day trading is knowing you have an edge over time. No different than the guy sitting at the card table playing blackjack at the casino. And guess what? After 4 hours, the guy walks away with $1,500. I've seen a guy do that, right? It was 4 or 5 hours. He did the same thing. He had an edge. He knew he had an edge. Day trading is never about the result of an individual trade. It's never about the individual day. It is never about the results of a week of trading, because you are going to have tough weeks. So the number one concern of day trading is, what does your system look like over time? I would consider your paper trading, what does it look like over a 3-month minimum look back? Okay? And all day traders are going to experience some drawdowns if markets are simply not moving. And I'm talking about the professionals. This is just an old chart here to show you 2004, 2005, 2006, and the incredible tight range. Now this is SPY. But you can see it was 108 to 116. That's nothing. It got tighter the next year. Well, I day traded during this. And I remember all the action happened during the European trading session. It was absolutely horrible. Okay? And we're talking 2.5 years of this stuff. And that's when I became like a grandmaster champion in solitaire. Okay. This is a numbers game. You get in and get out taking a series of trades rather than pinning your hopes on a huge trade of the century. Experienced traders know that we are like a mouse under the banquet table, and we're looking for crumbs during the intraday trading noise. Okay? Price runs up and down during day trading, and the day trader has trend and counter trend trading strategies capturing these moves. And the more you trade, the more your system has a chance to prove itself, as long as you trade to your plan as perfectly as possible. Now, what am I talking about? I'm talking about getting so upset and then you stop. And then, of course, that's when the market takes off. If you're going to do anything like stop, just have predetermined time. I mean, like, just say, okay, I'm not going to trade more myself. I don't like to trade more than about 2.5 hours. I'm over that. I'm over the whole sitting all day. Been there, done that. You've got to accept responsibility. How do you react under pressure of loss? How do you react when the trade looks really strong? Do you move your profit targets or follow your original plan? How do you feel if you're in profit and the thing suddenly reverses? How do you feel about that? Most people fail at day trading because they forget to think like an elephant, right? An elephant gets mighty big eating peanuts. And a day trader capturing a series of trades and then leaving the game, right, while waiting for the next trade, they're happy, even if they miss the trade of the century. So can you quit while you're ahead, or do you need just one more trade, right? I refuse to sit at the computer all day long. I've been there, done that. So you got to remember, the professionals want your money, and the longer you trade, the more you can get sloppy. Now here's the lure of trading. Wow, if I can just make $200 in one day, that's $1,000 in 5 days. Wow. And wow, in 4 weeks, gosh, that's $4,000 a month. And you plan it out, right? And this is the lure of trading. But once you start, the mind becomes the enemy. So you got to accept this and get that trading as mechanical as possible. All right. And regardless of your account size, start small with your contracts, please. You can tell the broker, I only want the ability for trading X amount of contracts until I tell you otherwise. I want you to shut me down if I lose X amount of money in one day. Because the broker wants you to stay in the game. All right, so you ask the broker, what tools do you have to help me from harming myself? And remember, if a broker imposed limit, like a daily risk level, if they have that, you cannot rely on that as a stop loss order, because markets can suddenly absolutely, you know, go completely against you. You never know when a black swan event's going to hit. All right, I'm kind of going into the overtime here. Patrick, you want to see if there's any questions?
Yeah, there were a couple of questions about you're trying to apply these principles to other markets, particularly the energies. So anything besides crude, like could you do, I mean, I would, caution people to be very, very careful with things like RBOB and heating oil, especially heating oil. I mean, those are really thin products, but have you ever experimented with any of those?
Natural gas, but not the rebob.
Yeah, the natural gas we do a fair amount of business in. RBOB and heating oil, I generally find that most people look at, use those, either they're looking at spreads or they're using those as a leading indicator for crude or something. But I would be very careful, Ken, you were asking about that with those particular products. A bunch of people asked about the recording. We will definitely have a recording posted. Hopefully it'll be up on YouTube within a day or so. George had asked, do you enter the market on market orders? So you're entering with a market order, or do you throw a limit in or an entry stop? How's that work?
Well, if we're working with something that is kind of a good market, fast market, I'm always using market orders, and I accept the fact that they're gonna hit me for a tick. I know that.
Right.
But I've talked to you about this before, about the time when I was in Russell 2000 and I had a 5-tick slippage, and I felt like I was the only guy trading.
Right.
So and that's when I don't trade the Russell 2000 anymore. But the thing is, and in that Russell 2000, in 1 minute, I've seen that thing go up $300 and down $300 in less than 1 minute. Right at the market open. The first 15 minutes are absolutely horrible.
Right. Right. Yeah, that's an interesting one. We don't do as much in the TF ever since they changed the tick value in it, and no one wants
Yep.
to pay them 100, ICE $111. But the Russell is going back to CME. It looks like in the third quarter of this year, and so we'll see what CME does with it. But we have had a lot of people, drop it or start looking at other small cap indexes like the EMD, which is quite thin
Yep.
over on Globex. But that's a good question. Uh, Randy, you had a question. I don't have range bars. What are their time frame? I mean, Randy, I think the general idea there is, well, number one, why don't you have range bars? Every charting program should have at least, that capability. If it doesn't, you might want to look around a bit. But time frames, the whole idea here is that you're looking for an activity-based chart. So the chart needs to be, the bars need to be built on something other than time passing. That's one of the core, ideas of what Martin is talking about. So I think you should definitely look at a charting program that has range bars available. We certainly do. JD asked about your template. So as you mentioned, we sort of made this template with your stuff on it. Who gets it?
Well, I don't charge for it, but to my clients. In other words, for people that take the course.
Take the course, be in the room, something like that.
Yeah.
Right.
If people take the course, then I'm not going to charge to give them the template.
Right. Okay. So that JD, that should answer your question. There's a couple other people who asked about that earlier as well.
Yeah.
So Martin is not selling indicators here. He's selling an educational service, and the charting program. Every group of studies to some degree stands on its own, but you need on its own it's not going to feel the same. So obviously you want to be a part of the room or part of his service if you're going to be using that template for sure. Don had asked, how do you determine what range to use in a given market? And this is probably these numbers can shift obviously based on volatility, but I'm guessing, and you can correct me if I'm wrong, that you sort of, there's a little bit more, again, as you said, art than science here, and if you use too narrow of a range bar, you get way too many bars. If you use too big of a range bar, you get not enough bars. I feel like I'm telling a nursery rhyme. There's one right in the middle. It's just right. But in my experience in general, that it's trial and error. I mean, markets like crude, 10, 15 ticks, most people will use. Markets like bonds, they just don't move as much. If you trade the 10-year note and you try to do a 20-tick range bar, you're going to get one bar the whole day. So you have to find a little bit of a happy medium there.
Right. If you look at like the NQ is what, like roughly double the size of the ES, right? So,
right.
So it's going to move faster, and if you are using a 10 range bar on the NQ and you get consistently just knocked out, your protected stop just keeps getting hit.
Right.
That's an indication, hey, I better widen this up a bit.
Right.
For crude, I will watch the crude 20 range bar, but I will, let me get rid of this. I will watch the 20 range bar, but my tactical entries are the 10 range bar. When I was trading the Russell 2000, I would watch the 20 range bar, but tactical entry on the 10 range bar. ES, strictly just the 10 range bar. I've used the I think it was a 512 tick chart. That was nice on the Euro, on the TF, on crude. That was very nice. I only went to the range bar charts because it was a way for me to make the system more mechanical, and I knew how much was always at risk with every single trade. That's the only reason I went. And I feel like, okay, this is one more way I'm seeing prices showing me, yes, I'm moving.
Right. That makes sense. I mean, that's, activity-based charts, especially range bars, that's not the first time I've heard that, and I think that makes perfect sense. Jeff, the CCI in Sierra, they actually spell out the words. It's called Commodity Channel Index. So the study itself is called Commodity Channel Index. So if you use Sierra, that's how it's labeled in there. There's a separate study in there.
It'll come up as a histogram as well.
Right.
Okay?
You can change the way it displays. I mean, there's a few different tools in there. Jay said, are you using the same approach with one contract entry as with a 10 contract entry? I mean, that Martin is not like, from what I've heard, Martin is not a like a complicated scale out type, trader. Therefore, really, there should be no difference in, in the way you enter position size wise. Although you just want to be conscious of the fact that in markets like crude or gold or the Russell, your fills are going to be spread apart, usually a few prices if you're trading 10 lots. 10 lots in the E-mini S&P, no problem. 10 lots in bonds, no problem. And some of the bigger or the thinner contracts, you just need to be prepared to deal with that.
Or maybe you've got a set amount of contracts you enter, but then you get another signal while you're still in the trade. You get a fresh signal. So that's the point where we will say, okay, now people can add to a position if they would like to add to a position.
Right.
We have a pattern here.
That's a good point. So you don't have to, shoot all the bullets at once. So, it's nice to have a few in the hopper for sure. So that makes sense. Range bars, Jim, range bars don't have to be bar charts. They can be candlestick charts. I mean, the idea is that it's just that each bar or candle has a fixed range based on the prior bar's close. So it doesn't really matter if it's a bar chart or a candlestick chart, although you could display them either way. The function, the graph draw type in our charting, for example, could be a candlestick chart. It could be a bar chart. Ultimately, that's a separate setting than the criteria used to build the bar, such as ticks, range, time frame, etc. Carl, the range bars are in the chart settings section in Sierra. So if you right-click, go to chart settings, there's a graph draw type, a a drop-down menu about in the middle of the screen that you can drop down that defaults to days, minutes, seconds. You can use that drop-down to change to range bars. We also have a good video on that on our YouTube page. And by the way, that's where this recording will go. Okay. Martin, and we only got a couple more after this. Keith had Keith is asking, so you would suggest that on average a 20 tick stop in crude? Is that kind of what you're thinking?
Yep.
Yeah, I think that's a pretty good number. I mean, anything less than that, and you know, you're getting stopped out for no reason. At least if you're going to be wrong, it's nice to be wrong. It's one of the reasons I like the mini Dow contract. I mean, even though, you know, we don't do a huge amount of Dow business. It's not that popular, but I like the Dow futures because you can risk 60 points in the Dow and still only lose 300 bucks. I just love the idea that you can do that. So it's a nice way, you know, at least you feel like if you get stopped out, you can have some assurance that, you know, maybe I really was just dead wrong on that one, you know. So you got to keep things wide enough. It's going to keep you out of trouble in most cases, we believe.
And a lot of times in day trading, you're in a trade, and if the market is not moving, time is not your friend when you're working with something like gold and crude. If nothing is happening, it's almost like a, you know, like a warning signal. Be very, very careful, because
I agree.
Out of the blue, they jack that thing up against you. And that's what I don't like about the quiet market when you know gold and crude should be booming. You know what I mean?
Right. It kind of feels like it's coiling up, and the longer you let it run while you're in the position and you didn't get the immediate response, you start to feel like you lose more and more control as every minute passes. So
right.
Yeah, I tend to agree with that. Okay. Okay, great. Well, I think that there's a couple more that I wanted to answer. Larry had asked Martin, the trading room that you have, that's 3 days a week, is that right? Or how's that work?
Yeah, it's Tuesday, Wednesday, and Thursday, and we'll start, say, well, the first trade will rarely take place before 9:45, and only because I just feel like the first 15 minutes are a killing field. Sure, there's times when right off the bat the market opens and they just go up or down and never look back. That's extremely rare. Extremely rare.
Right. Yeah, I agree.
Yeah, but otherwise I'll get in the room like around 9:20 in the morning, and then we just set up all the charts. Everybody sees me draw lines and all that, and maybe we look at the daily chart and just we just get prepared. The main thing is to be relaxed.
Right. Okay, cool. Well, that sounds good. I just posted a link. Everybody should see it, to the Contact Us page on Hit the Mark Trading site. This is when you go to that link in the bottom right, there's a thing that says join the mailing list, receive updates. This is where you can sign up to get the rooster call from Martin for a while. It is, I think it's a great piece of reading for the morning. I talked about it a little bit earlier today, so highly recommend that if you like a nice, well-written article that summarizes the evening or the night session and kind of provides some idea about what to look for the coming day, including some levels and some stuff that's actionable. I really highly recommend you take a look at that. Okay. Cool. Well, I think that kind of wraps it up. Martin, do you have anything else you want to mention before I take it over here?
Well, just that the course is $575. Some people think that, well, that's a lot of money. It's an investment. But the thing is, it's total immersion, and there is a difference. So I really suggest, if this speaks to you, try it out on your own. If it speaks to you, join us, because there's a lot of aha moments, and I think you'll really enjoy it. I think it'll help. Beyond that, Patrick, I appreciate it. I appreciate everyone being here. I love talking about trading.
Excellent. Well, thank you, Martin. We appreciate the time very much. And again, I've had some good feedback about Martin's service, and that's the reason why we're not shy about doing these events with him. So if anybody has questions about Infinity, about Martin, feel free to reach out to any of us. All of the link, everybody should have that by now. So if you feel like you're missing it or something, just reply back to any of the email you get from Infinity. We'll make sure to get everything in your hands. But that was great. Again, it's nice to have something actionable everybody can use the next day. It's not too complicated. And this is a good opportunity for some of the folks in this room who I know to try to maybe wipe the slate clean and take another approach, maybe a simpler approach. There's a temptation in our business right now because of the technology increasing at the rate it is to try to make things so overcomplicated and granular. That's my favorite word right now, my buzzword about a market analysis. Granular. It's like, let's look at the number of contracts that traded in the last 3 seconds at this price and try to be a high frequency trading bot. You're not going to win that battle. There are certain ways to there are a lot of different ways to look at things, but one thing I do find is that people are really trying to be the robot type trader, and it's just really hard to compete on that level. So you have to find another way. So anyway, I think that's about wraps it up. I'll take the screen over. If anybody has any questions, comments, we certainly appreciate any feedback on the events we do. We'll have it up on YouTube within a day or so. Everyone should get an email who signed up with a link to the recording. So much appreciated, Martin. Thank you so much for taking the time. I'm going to take the screen back here real quick and read some risk stuff one more time, and then we'll close it up. So, folks, thanks again. Martin, thank you so much, as usual.
Thank you. Bye-bye.
Much appreciated. All right, take care. All right, folks, trading futures, options on futures, and retail off-exchange foreign currency transactions involve substantial risk of loss. It is not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not indicative of future results. All right, everybody. Thank you so much for your time. See you next time.